When people think of coastal Florida, they think of the ultimate paradise. Mile-long beaches, luxury waterfront homes, and a life free from state income tax. It is the crown jewel of the American dream, especially for those looking to retire. But underneath the beautiful real estate brochures, a brutal financial trap has just snapped shut. Thousands of homeowners who spent their entire lives saving for a piece of this paradise are discovering a dark truth. Their homes aren't just losing value, they are becoming completely unsellable and uninsurable. And the worst part? Nobody warned them this was coming. The financial system is quietly shifting the ground beneath the middle class, and if you aren't paying attention, your home equity could be next. And this is where things get ugly. Imagine moving from the cold Midwest to a beautiful oceanfront condo in Naples, Florida. You calculated your mortgage, your taxes, and your retirement budget. You thought you were safe. Then, the mail arrives in 2026. It's an annual property insurance and maintenance bill totaling $13,500. That is not a mortgage payment. That is just the baseline cost to legally keep your home for one single year. The mainstream media keeps telling the narrative that Florida is a tax haven where wealth grows effortlessly. But on the ground, the reality is a nightmare for people living on a fixed income. Homeowners are quietly draining their life savings just to pay for insurance policies that cover less and less every year. Of course, not every county in Florida is experiencing this extreme financial lamb fat. If you live miles inland in places like Ocala, the costs are still manageable. But if your dream involved looking at the ocean every morning, the coastal trap is officially active. Most people blame local insurance companies for being greedy when they see their premiums double. But the real backstab is happening thousands of miles away in Europe. Local insurers don't actually hold all the risk. They have to buy their own insurance, known as reinsurance, from massive financial cartels in London, Zurich, and Munich. In 2026, these global reinsurance giants looked at the compounding storm data and raised their rates for Florida by 30 to 40%. This forced local private insurance companies into a corner. They either had to raise premiums to catastrophic levels or completely abandon the state to protect their corporate survival. The headlines say the government is working on a solution to stabilize the market, but the reality is that Wall Street is quietly pulling the plug on regular homeowners to protect institutional investors. Do you think the federal government should step in and penalize these global financial cartels for leaving American citizens exposed? Naturally, from a cold business perspective, no corporation is going to sign a contract that guarantees a financial loss. But this corporate retreat has triggered a secondary crisis that is destroying the condo market. Many retirees chose to buy condos instead of single-family homes, believing that a building association would shield them from the stress of property maintenance and storm risks. But they walked straight into a trap that is far more merciless. Following strict structural safety mandates passed recently, condo associations across coastal Florida are facing severe legal pressure. They are legally forced to fully fund their financial reserves and undergo intense structural inspections. The result? Massive, unexpected bills called special assessments. In older coastal buildings, residents are waking up to notices demanding $30,000, $50,000, or even $80,000 per unit, due immediately. This is on top of their monthly HOA fees doubling to cover the building's new corporate insurance policy. The buildings look magnificent and secure from the outside, but inside, elderly residents are in a state of absolute panic as these assessments exceed their entire yearly Social Security income. What would you do if your building association gave you a 90-day ultimatum to hand over $50,000 or face immediate eviction? To be fair, newer luxury complexes built with modern engineering and heavy cash reserves are navigating these mandates without hurting their residents. But for the average middle-class building over 20 years old, this is an economic purge. As these bills pile up, a lot of homeowners reach a breaking point and think, I'll just cancel my insurance, take the risk, and rely on luck. But the banking system has a lock on your property, and they will never let you walk away from the table. Over 60% of coastal properties are tied to a 30-year mortgage loan. Under the fine print of those contracts, going uninsured is a default. The moment your private policy is dropped, the bank's automated tracking system alerts them. Within days, the bank will implement what is called force-placed insurance. They buy a policy for your home through their own preferred vendors. The catch? It costs up to 4 times more than a standard policy, it offers zero liability coverage for you, and the premium is tacked onto your monthly mortgage statement. If you can't afford this new, artificially inflated bank payment, they will foreclose on your home and auction it off. The media narrative says a mortgage is an anchor of stability, but in an uninsurable market, it becomes a financial Kong-tae. And this pressure is turning what used to be a highly liquid asset into a frozen liability. This brings us to the core of the trap, the complete freeze of the coastal real estate market. When you try to escape by listing your home on Zillow or Redfin today, the market reaction is cold. Buyers in 2026 are highly educated. The first thing they look at isn't the kitchen or the pool, it's the insurance sheet. The moment a potential buyer sees a $12,000 insurance premium combined with a rising HOA fee, they walk away. Even if you find a buyer willing to take the risk, their traditional bank will deny their loan application because the property cannot secure affordable hazard coverage. Your asset is effectively locked. You cannot afford to keep it, and the financial system will not allow you to sell it to an ordinary buyer. The traditional real estate narrative says that coastal land always goes up in value because they aren't making any more of it. But a property that cannot be financed or insured has a real-world transactional value of 0 to the average American family. If a coastal condo was marked down by 50%, would you take the gamble and buy it knowing the hidden fees attached to it? Granted, mega corporations and private equity sharks with billions in cash are waiting in the wings, buying up these distressed properties for pennies on the dollar. But for the middle-class family who poured their life savings into their home equity, this freeze is a total wipeout of generational wealth. For years, Florida broke records as the #1 state for inbound migration in the United States. But a reverse migration wave is quietly gaining momentum. Data from the Census Bureau is beginning to show a steady stream of middle-aged Americans and retirees quietly selling out and moving back north to Georgia, Alabama, or the Carolinas. They are leaving because the cost of living under the surface has become completely unsustainable. The state government frequently boasts about the massive billionaires moving their hedge funds to Miami, but they ignore the silent exit of the working class, teachers, and nurses who keep the economy running. A paradise that prices out its own middle class cannot remain stable for long. Of course, this demographic shift is a natural rebalancing of a hyper-inflated economy, and it may eventually lower the strain on the state's overcrowded infrastructure. But it serves as a stark warning to anyone who buys into a media narrative without calculating the macroeconomic reality underneath. If you are watching this from Texas, California, or the Midwest, and you think this coastal trap is just a local Florida issue, you are making a dangerous mistake. This is a nationwide contagion. The exact same corporate strategy is unfolding right now across the country. In California, state insurers are dropping entire zip codes due to wildfire algorithms. In Texas, hail and wind deductibles are making homes practically uninsurable. The financial system is quietly rewriting the terms of the American dream, making homeownership a luxury asset reserved only for the wealthy. The politicians will tell you the housing market is strong, but the data proves the foundation of middle-class wealth is fracturing. Take a look at your own homeowner's insurance statement this month. How much did it increase? Let me know your state and your numbers in the comments below so we can track how fast this trap is moving across the nation. The U.S. economy will eventually find a way to stabilize the banking sector, and state governments may offer temporary backstops to prevent a total real estate crash. But before those macro solutions arrive, regular homeowners are going to have to navigate this squeeze on their own. Subscribe to stay ahead of these financial shifts, and we will see you in the next report.